going on, guys, and welcome. My name is Josh. This is Josh with Brave Finance, and here we invest $50 every Monday through Friday in dividend-paying stocks. Today, we are taking a dive into SCHD. Yep, I'm sure you've seen plenty of videos. A lot of people talking about SCHD. We've been buying it every day, and I'm glad that we are. But I want to take a dive into it. What is it? How does it work? Why do I personally buy it? Obviously do your own research. I'm not a wealth manager, credit counselor, financial advisor. I'm just a guy in a triangle-shaped room. But yeah, I think it's good to kind of take a dive into this. I don't think enough people talk about like what these investments even are. So that's what we're going to take a look at today, and hopefully kind of clear the air on what I think is a really good ETF. All right, guys. So for those who aren't familiar with SCHD or have never heard of it, I have it pulled up just a snapshot on Seeking Alpha. But right up here, SCHD is Schwab's U.S. Dividend Equity ETF trademark. So basically, this fund exists to grow with the market and pay out some dividends later in retirement or whatever you want to do. So just at a snapshot, it hasn't been around a long time. It came out in 2011, so the official start date was October 24th of 2011. Like 11 and a half years now, but it's up 180% from then, so that's a great thing to see. And this is the thing that gets people so interested. The dividend yield for the trailing 12 months is 3.62%. But wait, there's more. The expense ratio is extraordinarily low. So for people who are unfamiliar with both expense ratios and trailing 12-month dividend yields, so here's what that means, right? All of these major funds charge a fee to have someone manage your money, okay? Which makes sense. If you're giving somebody to make you money, for 11 years and then it's up 180%, you've been getting paid out dividends the whole time. Yeah, you probably owe them some dough. But these guys charge 0.06% as a management fee yearly. So just to put that in frame of reference, like if you give them $10,000, they're gonna bill you $6 to manage that money. So if you have $10,000 of SCHD, again, the management cost of that would be $6. That is just staggeringly low. We'll look at a couple other examples in a minute, but just that's really, really inexpensive. The other thing here, that trailing 12-month dividend yield. So a dividend is when you are a shareholder, you're going to get paid out a percentage based on what you've got. So if you see in the movies, and I say this a lot in the channel, but when they're like, we got to pay the shareholders, that's you if you own SCHD. So yeah, that's pretty awesome. Basically, for every $100 that you have invested into SCHD over the past 12 months, you would have been paid out $3.62 of cash money. Now, most people choose to reinvest that into more shares of SCHD. But however, if you're looking for something to retire where you don't have to, sell off your shares or anything like that, if you got a big enough balance, you can do that with something like SCHD. You're getting paid out $3.62 a year for every $100 you have invested. That can add up pretty quick. And if you guys don't follow the channel, you check out some of the other like video diary journal videos, because you can see how that adds up pretty quick. We document that every Monday and Friday. So Anywho, but yeah, so that's basically why it's appealing. Not only do you not have to pay somebody to really manage your money, I mean you do, but it's so small. But you're getting paid out big checks relative to having a pretty low maintenance portfolio. Um, but that's what people are talking about. What does that mean? Let's take a look at some comparisons here. And before I do, like, it's always good when the ratings say buy, everything for value and liquidity and everything is all A plus or B. Like that's a good sign. But let's take a look at SCHD. I mean, against SPY, which is like the big S&P 500 fund that most people are in, or VOO, which is another very popular, high-performing fund. Most people use these as benchmarks to what is a very, very good, stable, kind of one-stop shop investment for retirement. So let's take a look here. What we're looking at right now is SCHD, this line right here. I'm colorblind, so bear with me on that. We have SPY right here, which is like the S&P 500 basically. We have VOO, and they're all similar, but you'll notice in the price growth of SCHD, it is the worst, okay? So before you click off the video and you're like, why did you make me watch this? I've been watching this for 3-4 minutes already. I clearly don't care about the worst. There is one missing component to this price return chart over the past 5 years, and that is the dividends that are paid out. So if we take this from price return and move that to total return, you'll see something happen here. If you're reinvesting those dividends, SCHD now very much outperforms the other two. Hold on, I got a crazy little man with a rocket in my office. Say hi.
Hi.
All right, now go back to mama.
Okay.
Thanks, buddy. Sorry. What are you doing, buddy?
You got this balloon.
I see the balloon.
It popped.
I know it popped. Now get out of here so I can make a YouTube video. Okay. Sorry about that. All right, so diving into something else. So the other thing that I love about SCHD, and this is one of the reasons why it's in my portfolio, is because their dividend growth. So as I said, the fund's been around for 11 years. For the past 10 years, they have increased their dividend every single year, year over year. And their 5-year dividend growth rate on average, sorry, it's so exciting I can yawn about it, is 15.56%, guys. That is huge. 15.56% it's just unbelievable. So what that means, right? If you remember at the beginning of the video, I said that if you put in $100, you'd get paid out a dividend of $3.62 based on last year. Okay, so if you take that the next year, right? So 3.62 times 1.1556. So the next year, if things continue on the same trajectory they have for the past 5 years, that means you should be looking at a dividend payout of $4.18 for having $100 in the thing. So not only have you put $100 in, assuming you did not reinvest your dividend payouts, right? Let's say you just took them. The next year you have $4.18. So that's now you've made a total of like $7.80. That's really good for getting paid for not having to sell stuff. And it just, that dividend payout is continuing to grow over time. Now, if you reinvest those dividends, that's where the dividend snowball comes into effect. And what the dividend snowball is you have your $100, you get your $3.62. Well, now you're not only getting paid the higher dividend, but you're getting paid the higher dividend on $103.62 instead of $100. So it's just that much more. And that kind of grows out of control. If you guys haven't seen any videos or learned about the dividend snowball, that is something to look up. Maybe I'll make a video on that. But so that's a pretty exciting thing. If you know that your payouts are going to increase on average 15.56 per year, or that's what they've been doing, and they've grown their dividend consecutively for the past 10 years, that's a great indicator. You know, when you look at this dividend growth chart, this shows how much it did grow year over year. Obviously, the first year there's kind of a big boost when they realize this is going to work. But after that, I mean, it's been pretty consistent within that 7 to 20% range. So, you know, I'm looking forward to that continuing to grow. But enough about that. That's kind of an intro snapshot. Now it's time to look at the fact. All right, so as always, when I'm looking for the facts, I'm going directly to Charles Schwab's website. This is their asset management website where they basically lay it all right out for you. And again, when I say do your own research, like this is kind of what I mean. Log into an account or go onto someone's website and read their reports, read their shareholder information, all that. But anywho, Schwab U.S. Dividend Equity ETF. Symbol, SCHD. That expense ratio, boom, right up top, 0.06%. That is fantastic. Anywho, so what's this all about? Objective. The fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones U.S. Dividend 100 trademark index. Highlights. This is a straightforward, low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio. As I said, it can be kind of a one-stop shop. Tracks an index focused on the quality and sustainability of dividends, again, getting paid, and then invests in stocks selected for fundamental strength relative to their peers based on financial ratios. Okay. Excuse me. All right. So these guys basically, they're trying to take the best of the best of the Dow Jones U.S. Dividend 100 Index and kind of put it all together proportionately based on who Schwab thinks is doing great relative to their peers. Seems reasonable. Like, that's how I would buy stocks. I'd say this company makes more money and it costs the same, so let's buy that. Now, this is where it gets juicy, okay? So we have the previous close value, previous open value. You know, that doesn't really matter that much. At least to me, it doesn't really matter right now. Today's shares of volume. Now, this is going to be as of the 6th, okay? Today is Easter Sunday, so everything's off by a little bit. But today's volume, 2.5 million shares of this were traded. What does that mean for you guys and myself? It means that if I want to sell this or I want to buy it, I can, right? It's not something that you're going to have to wait to sell shares or buy shares. It's moving back and forth all the time. You know, the median bid-ask spread is 0.01%, meaning if you're buying it, you can buy it on the spot for what it costs, sell it for what it costs without having to, you know, pay 10 cents more or whatever. Like you're going to be able to just buy it and sell it whenever you want, which is nice, or at least as is my experience and as is what this is saying right now. So key fund profile data. It was started on October 20th of 2021. Again, that's actually still relatively new in the grand scheme of these funds, guys. You know, it's more than 10 years old. Whew. God, I'm tired. So it's a little more than 10 years old. But it's performing great, and everyone's kind of like jumping on the train now. Total net assets. So net assets as of the 6th of April was 46,500,714,702.51. That is a lot of money. Wow, that's a lot of money. So they have a ton of stuff going in and out of this thing. Um, which is a good thing to see. It's not like they have liquidity issues. They have these assets. Yeah, it's good. They got enough stuff going on to be okay. At least in my humble opinion of not a financial manager, wealth manager, credit counselor, none of that. The shares outstanding, there are 637,300,000 shares. Those shares are, sorry to scroll up fast, but they're about $73. Pretty good. Holdings, they hold 104 different things. All right. So we'll scroll down. Management style passive. They believe in buying good things. Okay, buying good things, holding on to them for a long time. Distribution yield. Here's that 3.44. It was a little bit higher on the other one. That's going to change day to day as the market fluctuates. It just is what it is. But yeah, I mean, that's it at its core. But more importantly, what do they actually have here and what's going on? So I guess before we get into that, or what they have here and what's going on, I guess this is the what's going on. So we have the fund performance right here. 13.81% a year since it was founded. That's a very, very good return there. Their Morningstar rating, it's basically large cap value stock investing. Pretty simple stuff here. Their dividend yield is low management fee. This is all just the same thing. This is like the snapshot. I hate when you get like a book of 401k stuff from your work and they like give you a bunch of these printouts, but then you can't see what they actually hold. It's the worst. Like, who wants to read this? I don't want to read this. I guess the top 10 holdings is nice, but we're going to see that way better. Let's close this. That's frustrating to look at. All right, so here are our top holdings and all of the holdings of SCHD. Look at them. As I said, there's 104. But we're going to focus on the top 5 here, right? So these top 5 are all at a market value of $2 billion. So what are these top 5 assets? They have AbbVie Inc. It's a like a pharmaceutical company. We got Verizon. We've got PepsiCo, which I'm a huge fan of Pepsi. As far like the sodas are good too, but as a stock, they're fantastic. Amgen, another like biomedical company, and then Cisco Systems. They do everything, like IT stuff. Anywho, so those 5 stocks alone, right, make up 21%, roughly, of the entire thing. All right, 21% roughly of the entire thing. As we add in the next few, we have Coca-Cola, right? That bumps us to 25%. Chevron, that bumps us to 29%. Pfizer bumps us up to 33. I don't know what Merck & Co. is. I should probably look that up. Books. I mean, when we get down to like Broadcom or Home Depot, Lockheed Market, and BlackRock, I like BlackRock a lot too. But as we get down here, I mean, that's 50% of the portfolio in like 20 stocks. So, really, if you want to see what they're all about, I would dive into these. We are going to look at basically like the top 5, because I think that they'll, generally speaking, like paint the picture here. So looking at a 5-year chart, because that's what we were looking at before, first stock up on the list is ABBV, AbbVie Inc. Again, this is another one of those pharmaceutical companies. In the past 5 years, they're up 78.55%, and they're paying a dividend yield of 3.66. Well, that oddly looks relatively familiar when you're looking at the SCHD chart. Let's just pull that back. A little less performance from SCHD. The dividend yield is right about there. But you're going to see kind of a similar trajectory. As we look at Verizon, now Verizon on a 5-year chart is down, but their dividend yield is 6.61%. So, there's a little bit of the higher dividend payout coming in to help the lower stock. Maybe we'd be doing a little better if we didn't have Verizon, if we had AT&T, but I'm not going to say that, but that's okay. Anywho, so if we go over to Pepsi, Pepsi is a giant or growth giant. So 68.55%. It is outperforming the growth rate of SCHD, but they are underperforming with the dividend yield. Okay. So again, that's why they have all these different funds. Some of them will contribute more growth. Some of them will contribute higher dividends, and it makes it so it's a lot easier to manage your money. Popping over here, Amgen, this is that biotech company. They're paying basically right on point with Schwab or SCHD. Yeah, 50% here with the 3.62. We have 49.35 with the 3.36 percent dividend yield. So yeah, very, very good, consistent growth stocks with dividend yields that are pretty high. I wanted to just show a snapshot of that because, if you pull the top 5 funds that make up like 21% of a portfolio, it should sort of reflect, and it does. Verizon's kind of the one random weird one here where it's down 15.86 for the past year, but at least that dividend comes in at 6.61%. What that means is if they have another growth stock that doesn't pay as good of a dividend, let's say it paid no dividend, right? Just for math, right? But if you had a big growth stock with a very small dividend or no dividend, the dividends would average out to around 3.5%. And then you have the opportunity for better growth from Verizon. So that's sort of the benefit of something like SCHD versus, trying to pick your own stocks, I guess. They do a pretty good job at that. It is a shame to see the Verizon stock coming down. That's not good. But anywho, that's SCHD kind of as a whole. Now, why do I like it? Why do I have it? All right, so we're here at dividendathlete.com, okay? The reason we're here is to go over why am I such a big fan of SCHD. Now, I have everything set up here in this calculator using rounded down current figures. And I'll bounce back to SCHD on Seeking Alpha so we can make sure these numbers are correct because it is a little bit unbelievable. But the way I have this set up is as if we had a $6,000 balance contributed into our Roth IRA and we never invested again for the next 20 years. Probably not what anyone would ever do, but let's just look at it that way because it really kind of nails this home. So I have the annual dividend yield listed at 3.6% and the expected annual dividend increase at 15.5. Where did I come up with those numbers? Let's go back to their historicals. So I had it at 15.5. Their 5-year growth rate is 15.56. So I found that to be appropriate. And then I used 3.6 on their calculator. The trailing 12 months was 3.6 2. So I rounded both of those figures down because I think that's a fair and reasonable thing to do. I did also set it up for DRIP, or Dividend Reinvestment Program. So it will reinvest those dividends. And in the comments, I would like you guys to put in how much money you think you would have after 20 years of this. Okay? So take a minute, put that in the comments just to keep yourself honest. I don't want to see no changed comments in there. Maybe add in like an LOL after. But if you were to do that, 6,000 just up front, never invest another dollar, right? Scrolling it down, you would have $173,550. Not only would you have a ridiculous amount of money, but you would also be earning $6,109 a year in dividend payments based off of those numbers, right? So past performance does not guarantee future results. If that was the case, I could still jump up and dunk a ball and hang from the rim. But that's not true. So past performance definitely does not determine future results, but we can make educated decisions based off of previous averages, and that is exactly what this is. So putting in $6,000 and just waiting 20 years to retire, yeah, you'd have this $173,550. And again, we talked about the dividend snowball effect. It's because that payout is growing on average 15.5% a year. That's ridiculous. So what happens if you just add another $6,000 every year, right? We're responsible. We're investing into our Roth IRA, and we go for 20 years. Let's see what that does. Well, we made it past $1 million. All right, so $6,000 a month, that gets us to $1,047,000. That's ridiculous. As a total, you would have put in $120K, and now you're getting paid $36,800 a year in dividends. Guys, you can take that money out without ever having to sell off your principal. Okay? You wouldn't have to sell any shares ever, and you could just take 36,000. So for some people who they want to retire and they just want to never work at all, that's probably not enough to do that. But for somebody like myself, like I basically want to retire to like be a high school basketball coach or something like that. So I can like make a difference in the community. I want to retire when I'm younger so that I can like still be there for my kids' stuff. But like 36,000 might make that doable. Maybe I don't need to make 6 figures at my job anymore. Maybe I can take something that's a lot more laid back, get good healthcare, get good benefits, and then, set my expenses up to live off of the 37,000 that I take home from my stocks, and everything else is funny money and travel. So, there's a lot of ways that people look to invest. I think that's not a bad way to do it. But again, that's only 20 years. Guys, if we push this out 25 years, it's going to skyrocket. Look at these numbers, guys. If you can hold off for 5 more years of just putting an extra $6,000, or you put $6,000 a month more, right? Or just $6,000 a month still for the extra couple of years, you're making $90,000 a year. You have $2.5 million in the bank. It's so unbelievable what the dividend growth rate can do here, guys. We went from 20 years with $1 million to 25 years. So 5 years later, we're pulling in $2.5 million. And the reason is these dividend payments that you're reinvesting are just supercharging your growth. I mean, let's push this out to 30 years, right? I'm 34. If I retire at 65, look at that. So you go 35 years, you have $15 million in the bank. So, that's a lot of ridiculousness. But hold on, let's scroll back down. Hold on, I'm getting ahead of myself here. It's just this stuff excites me, guys. 35 years of investing $6,000 a year into SCHD. If it continues at the same rate that it's going, same dividend growth, all that, you are earning $525,000 a year without ever selling a share. Okay, so for everyone out there who's 20 years old and they're looking at like, how do I set myself up to retire when I'm 55? Okay, 55 years old is so young. And for $500 a month of SCHD until you're 55, if you can not tap out until you're 55, guys, you're looking at $500,000 a year. What's even more ridiculous than that? You would have taken $210,000 out of your pocket for the first for 35 years. Over the course of 35 years, you would have invested a total of $210,000. That's it. And you're making double that, more than double that, every single year in retirement. And that's absolutely bonkers. And that's what's gotten so much attention with SCHD, because it's just ridiculous. The growth rate of the dividend is ridiculous. The dividend's already high and it's growing quickly. I mean, if you start investing today, you'll get 3.16 or 3.6% in your dollar. Your dividends on cost, so like the total amount of dividend you're getting paid out versus what you initially invested, is 250%. That is the most ridiculous thing I've ever heard in my life. 250%. That's so just bizarre. Granted, it's 35 years. It's a long time, but if someone told me when I was younger that I could slowly, gradually set aside $210,000 over the next 35 years, and I'd be sitting on $15 million in an account, I would do that. Right? So now we're doing that. I'm playing catch up, trying to get that in now. On this channel, we talk about it. I have a portfolio that's on the channel that we started this year for the channel. We're putting $50 into the stock market every Monday through Friday. That's $13,000 a year. Hopefully we can supercharge this or accelerate this process. But let's do that. If we start with 13K a year, guys, in 15 years, we're looking at, if it was all in SCHD, which it's not. I have a couple things in there, but I do have a lot in it in SCHD. That's $1 million almost in 15 years. I mean, that's great. So, anywho, that is why the world is excited about SCHD. Okay. Again, do your own research, look into stuff, watch more content from me, from others. I would try to read actual articles and shareholder releases from Schwab. You know what I mean? That's the kind of stuff that people just don't do. They always only go to YouTube, and take it from a financial advisor. Don't take it from me. I am a regular guy. I can't say it enough. But if you found this interesting, I would appreciate a like. Throw comments in there. If you guys have something that I missed or something you'd want to add or a question or whatever, throw it at me. If you aren't a subscriber to the channel, please throw me a subscribe. If you find that you're looking for a little motivation in your day to check in with just the struggles of a guy investing every day. But, and if you're not investing and you want to dip your toes in, you're looking for a place to start, I'll have a link down in the description for Sofi Invest. Sofi has been an awesome platform for me that I do invest with. They have a link right now where if you sign up with the link below and you start an account with a minimum of $10, they actually give you $25 of free stock. So like right off the rip, that's a gainer. But they do also allow partial shares. So if you wanted to buy some partial shares of a stock like SCHD or whatever, it's a really good way to get the ball rolling, throw $5 a day or something like that into SCHD, and just start building wealth. That's not a pitch for that either. That's just it is what it is. So yeah, I'll have a link in the description for the free stocks. And then yeah, as always, I wish you guys happiness, health, and wealth. And with that, roll the outro.